Most people think global shipping stops when a port closes, a missile lands, or a ship gets stuck. But sometimes trade freezes for a quieter reason. The ship is ready, the route is open, the cargo is loaded, and the insurance disappears. That matters because modern shipping does not run on steel and fuel alone. It runs on contracts, liability, and financial cover. And when war risk insurance turns unaffordable, restricted, or unavailable, ships can still physically sail while the business case for moving them collapses. In March 2026, that hidden layer suddenly became visible. As conflict around Iran and the Strait of Hormuz intensified, maritime war risk premiums surged. Some insurers cancelled cover in the region, and governments and insurers rushed to build emergency backstops to keep traffic moving. This is the story of a system most people never see, and why it can move prices around the world. To understand why, you need 3 buckets. First, hull insurance. That covers physical damage to the ship itself. Second, protection and indemnity, usually called P&I. That covers liabilities the ship owner owes to other people, from pollution claims to crew injuries and collision-related costs. And third, war risk insurance, a separate layer designed for conflict-related exposure, such as strikes, mines, terrorism, or other hostile acts. These categories sound technical, but the logic is simple. A ship is not just a machine, it is a moving stack of legal and financial risk. If one layer in that stack is missing, everyone around the voyage gets nervous. Owners, charterers, banks, ports, and cargo interests. And that separation matters. The International Group of P&I Clubs says its member clubs provide liability cover for about 90% of the world's ocean-going tonnage. But standard P&I rules do not simply absorb war losses by default. In practice, war risk often sits in a separate insurance lane. Gard's Rule 58 makes the logic explicit. If a war risk is the proximate cause of the loss, standard P&I cover is excluded. That is why marine war risk exists as its own class of insurance. In other words, a ship can be perfectly ordinary on Monday and commercially radioactive on Tuesday if a road suddenly becomes a war zone. The steel has not changed. The economics around the steel have. That is exactly what happened around the Strait of Hormuz this month. Reuters reported that hull war risk premiums for some voyages jumped from around 0.25% of a ship's value to as much as 3%. On a very large tanker worth a few $100 million. That can mean millions of dollars for a single trip. Reuters also reported that some marine insurers cancelled war risk cover for vessels operating in Iranian and surrounding Gulf waters, while London's marine insurance market widened the region treated as high risk. At the same time, Chubb announced a dedicated war risk facility to support ships moving through Hormuz, and the US offered maritime reinsurance support. When private cover gets stressed, everyone starts looking for a backstop. So why not just sail anyway? Because shipping decisions are not made by courage alone. An uninsured or underinsured voyage can violate financing terms, wreck a ship owner's balance sheet, expose charterers to liabilities they do not want, and make counterparties refuse the trade. Some forms of maritime liability are also backed by compulsory insurance, or financial security certificates under international conventions. So insurance is not a decorative line item. It is part of the permission structure of modern shipping. If the cover is too expensive, too narrow, or suddenly gone, the route may still exist on a map while it stops working as a business. And once that happens, the shock spreads fast. Around 1/5 of global oil and a large share of LNG normally moves through Hormuz. So when insurance costs spike, ships reroute, delay departures, demand higher freight, or wait for protection. That lifts the cost of moving energy, pushes refiners and traders to hunt for replacements, and feeds into freight, fuel, and inflation pressure far from the Gulf. The important part is this: the world does not need every ship to stop. It only needs enough hesitation in enough critical voyages for prices everywhere to feel it. That is why marine insurance matters far beyond the shipping industry. It is one of those invisible systems that only becomes visible when it breaks. Sometimes the world economy is not stopped by the sea. It is stopped by the policy behind it.